Well, great to be back with you all. Thanks so much for having me, David. And I'm excited to share with you all how I like to trade options on Facebook, Amazon, Apple, Netflix, and Google. I am Price Headley, the CEO and founder of Big Trends. I founded the company November 15th of 1999. And so now we just have celebrated our 22nd full year anniversary. Very blessed to have served many thousands of traders over these past couple of decades plus, and looking forward to many more years to come. And it's an exciting time to be trading because the time of year is really good. Usually we have got quite a lot of bullish seasonality. And I love trading these Fang names because they really give me some of the best liquidity in and, more importantly, out. So we're going to walk you through that today, how I like to find these, and share with you some of my favorite elements that go into selecting the right Fang option to trade and how to get in, how to get out. Really clear cut. Now, just a reminder that everything that I share with you today is for your information and education only. Nothing we talk about here should be considered a specific recommendation to buy or sell any particular investment. Of course, you know that you are 100% responsible for your own investment decisions. Big Trends and staff are not responsible for any trades you choose to make. And not all Big Trends products and services are appropriate for all traders and investors. Big Trends does not provide any personalized financial, tax, or legal advice to any individual. What we do instead is we call out our Fang signals, both entries and exits, on every trade in real time via email and text alert to our subscribers' smartphones. More on that a little later. Do consult your tax advisor too as you make any investment that might impact your unique tax situation. So if you don't know me, like I said, I founded Big Trends back in '99. I had worked for in the '90s, the biggest options newsletter in the country, and then realized with the power of the web that it was just such a natural thing to be able to use the web to communicate options research and market research in real time so much easier. So my big thing when I launched the company was to really focus on a systematic approach, which is saying, do we have an edge over a large sample of trades? Knowing that you can't predict any one trade within a system. You could have the best system in the world and still have times where it's going to have losses and givebacks. And so that's where a lot of traders get themselves in trouble, is getting too high or too low. And my big thing is I want you to just really focus on being very consistent, starting small and building over a longer period of trades and a longer period of time. So I've been blessed to help many thousands of traders. And so we're going to talk today about what the Fang stocks are all about, why I love using weekly options on them. You've got to make sure that you just control your risk with weeklies as you're trading closer to the expiration. We're not going to trade them the last day or two of the options life. We're going to be out there usually about a week to a week and a half away from the expiration when we get into a trade. And we're not going to hold it for longer than 3 trading days. Usually it's like anywhere from 1, 2, or 3 sessions that will be in and out of these Fang stock options. There are also these Fang names, because they're so high dollar. Amazon's trading over $3,000 a share. So you buy 100 shares and you're going, okay, 300 grand. I don't think we want to commit that kind of capital to this for the typical trader. We're saying we won't spend more than $1,000 to control 300,000 plus worth of stock. So that's another plus. So ATRs, high ATR Fang stocks, means that they have a high average true range. It means they move a lot, and they move a lot in absolute points. And then we can break it down into percentages too and show you why. My philosophy, even from 22 years ago when I launched Big Trends, I did it on the heels of the late '90s internet tech run up and doing well on my own account to build the capital to essentially self-fund, walking away from a nice paying job to starting from $0 and building over these past 22 years and been just blessed to keep going strong. So we'll share with you that. But the big thing I want you to take away here is my number one indicator to find trending stocks. So if there's anything that you can start to implement on your side, you'll see what I'm talking about when I get into this indicator. But first, let's talk Fang stocks. Obviously, most everybody's aware of what that acronym stands for. It was initially stood for Facebook, now called Meta Platforms, and due to change their symbol, we'll see how that mangles the Fang acronym at the start of December. But bottom line is Facebook, Amazon, Netflix, and Google. Now, of course, Google's even renamed itself to Alphabet as the parent company. It's strange what these big firms are doing, but the bottom line is that acronym originated, and we always said that Apple should be a part of that mix. And now it's almost kind of commonly accepted knowledge that Apple is part of that Fang equation, and you'll sometimes see it written FAANG. Some people argue Microsoft should be a part of it. And you can do what I'm going to teach you here. You can do across any stocks. You can use it on Microsoft. And we do use it on Microsoft and a variety of other weekly options names and an additional service. But we're focused on just the core original 5 Fang names here. So we're going to get into that. So why should you care? Why does it matter? Well, when you look at Google, GOOGL is the symbol we like to use to still call it Google, because we don't alphabet something when we search for it. We Google it. But parent company Alphabet, we had recommended back here in September, as an example, a put option. And we only buy options with this strategy. We keep it really simple. A lot of people don't like buying options because they're worried about the time risk. But when you're going with a directional strategy, as long as you can control that you're not going to be in the trade for too long, you're not going to get into that justification game. And thank you, Jurgen, for the congratulations on the 22 years. I appreciate it. You're not going to get into that justification game of saying, well, it's a good company, so I'll hold on. You must leave that kind of thinking at the door when you get into options trading, because you are now trading a time-limited asset. We trade a put option, which means that we have a right to sell Google stock at a fixed price of $2,740. when Google was trading a little bit above there. So that $950, it's quoted as 9.50, but on an option contract, you've got to multiply times 100 because you're controlling 100 shares of stock per contract. So therefore, one option contract costs us $950. So for a lot of our subscribers coming in, we'll say, just start with up to, but no more than $1,000 a trade. And we'll never typically hold more than 2 trades, or a maximum of 3 trades open at once. But usually these days it's 2 at a time, because we don't want to be loaded into all 5 of them at once in case the market does some kind of if we're all bullish and then the market flips on us, we don't want to get 5 times the leverage against us, right? Leverage is a great thing when it's working for you, but it's a bad thing if it works against you. It's the double-edged sword. So the goal here is we want to let our profits run and cut our losses relatively quickly. We'll get into both sides of that. In this case, it gapped down the next trading day, and we made more than our typical target. Usually we're targeting 100% gain. In this case, we got 171.5%. That is not typical. That is atypical. Usually if I go from 50, 60, 80, 90, 100%, at 100%, I say, ring the register. We have an order working. If we got in at 950, it's really simple. We'll tell you, hey, multiply times 2, and we'll put out a follow-up email and text alert saying your target is now, in this case, $19. And you say, well, then why'd you get out of 25.80? Because the stock gapped down more past that $19 target, moved on up and we sold it soon off of the open at 25.80. So that was, again, an outlier. Sometimes gaps can work for you. Sometimes they can work against you. It's just that's called trading. That's why you don't want to be in too heavy. This is over $1,600 of profit in trading just one contract. And all my examples here are before commissions. As you know, past performance doesn't guarantee future results. The future will be different from the past, but we're looking for patterns here. We're looking for a recurring theme, and I'm going to share that with you on how I find these trades. So we're going to get into the charts here, which of course are worth many thousands of words here with the pictures here. So what are we looking at here? There's a few things happening on this chart. This is where we got in, and this is, by the way, a 30-minute chart. These are TradeStation charts. You don't have to have any certain platform to do this, because most all the platforms have these indicators. Now, what we do is, and we give you all the indicator settings when you become a subscriber, but I'm going to go through the core indicator principles here. Is we were getting a signal at the close of this red candle here. So right in here, when you can see Google, if we take it across here, is trading in the neighborhood of about 28.30, give or take. And we're buying a 90-point out of the money put option. That sounds crazy to a lot of people because they say that's really risky, right? 90 points, isn't that a lot? I always say, remind yourself of how much of a percentage move that is against the stock's value at the starting point of this downside trade. which was 2830. So you say, well, multiply 2830 times 3 and you're almost to 90, you're to about 81 points. And then you're saying, so it's just over 3% move down gets you to the strike price. Now, you don't always have to get to the strike price to get paid. And that's what happened here. You can see that we're starting to make money here on that first day in the trade. Notice we got in here somewhere just around the noon hour. That was on September the 17th. This is all Wall Street time, Eastern time. Now, what's driving this trade? What's driving this trade here is this green line, which is called the ADX. That's the one I want you to really focus on and learn about here. ADX is the average directional movement. I'll get more into the underpinnings of that. And in this case, you've got a negative directional movement in red that's above the blue positive directional movement. So when ADX is crossing up and starts to keep going up here off of a relatively low level here, you can see that that's actually a trending phase. In this case, the criticism of ADX is that it may show you a trend if ADX is rising, but it doesn't show you which direction. We answer that by overlaying these red and blue, negative and positive directional movement lines. What does that mean? It just means, are you making new lows? Then the red line's going to be going up. Are you making any new highs? No. Then the blue new highs line is going to be going down. So what ADX is picking up is the gap between those DMI lines, the directional movement lines, is actually widening, and thus ADX is starting to rise to say, hey, something's going on where this thing is trending. So more on that in a little bit. But ADX rising is our first objective, and it must also be below a longer term moving average filter. This black line up here, it's below it. So if it was above it, we wouldn't take the trade. But below it, as these things are breaking down, that's where the heat can be applied, where the institutions start dumping these stocks and saying, oh, this is not a good looking chart. This thing's breaking down. I need to get out. Well, you can see by the close of that first day, the stock had moved in our favor to the downside by maybe almost 20 points, maybe even 15 points, not that much. And then look what happens the next day. It finished at just about 28.20, and you see where it opens here about 27.60. It gaps down 60 points. That seems like a lot, but again, it's a little over 2% on the stock value, right? So we didn't even get to our 27.40 strike price, and we're taking an outsized, as I said, an outlier of more than our 100% target because of such a big gap, making that 171%. Now, in the old days, I would have said, wait until ADX rolls over, give it a chance to keep going. But you see, by the time that this flips here and closes back up on the price action, which pulls the ADX down because it's too much of a reversal against the downtrend, the directional movement lines are starting to flip. You see the positive directional movement is starting to rise because you're making a little bit of a new high over the last, maybe 10 bars of action there. And of course, the negative directional movement is starting to come down here. So that's where the ADX flips. In the old days, I would have said, wait for the trend to end. But my experience with that is that there's too much gap risk coming into the next day and or to even just a violent counter trend move when it finally does flip. So we take the money and run at a double, or in this case, at a better than expected profit on a gap, and say, take that double or more and go on to back to cash and back to waiting for the next setup. But what you'll notice on these charts is that there'll be lots of periods where there's just a lot of chop, like you see on the left side of the page over here. What's ADX doing? Well, you see there was one cross back here, and we might have had some other positions on where we didn't take that trade a couple of days before. But you see, essentially most of that way, ADX is dropping or staying relatively low under the DMI lines, is especially when it's real choppy here. So we stay away from that type of a phase, and we move on to find fresher opportunities when the trend really starts to get going. So that was a bearish put option example. Now let's talk about a bullish call option example where you expect the stock to rise. We'll come back to Google first. We'll look at other ones, don't worry. And you can see on this chart here that, back here, this was in late August, we said with Google, let's buy the September week 1 2860 call. So what does that mean, September week 1? It means the first Friday in September is the expiration day. At that close, this option will no longer have any life left. Obviously, we don't want to wait till that early September expiration. We will typically, like I said, if it's not hitting our target or our stop, then we will say, let's just go ahead and blow it out after 3 trading days if it hasn't done anything. You can see after a period of chop, it's chopping around this moving average line and chopping around on the DMI lines. They were looking more negative on the left side of the page, but we didn't get a break of the moving average to the downside until right there. And by that point, the ADX was already too high. So a lot of people, by the way, one of the mistakes I believe people make with ADX is they say, oh, ADX is trending. We've got a good looking downtrend, but they're getting in too late when ADX has already risen too much. I like it when ADX is coming from around this 20 level or less and then starting to get going here. And you can see in this case, it does simulate at that close that the stock's breaking out in price action above those recent highs. It's not always the case, but in this case, it is a confirmed price breakout that ADX is confirming as indeed a trend that still has legs. It still has a freshness to it. You know, when you think back to trades that you've not only made, but also didn't make, how many times can you look back and say, I've seen trades where I thought it was way too extended, way too risky, and then it went on a lot further than I or you could have expected. You know, we've all been there, right? Just out of curiosity, let me ask you to give yourself a grade if you feel so brave as to how well have you done taking advantage of trends in the 2021 market? Have you taken advantage of this overall uptrend? Have you been able to manage the risk through the little pullback in September to early October? You give yourself a good A grade if you feel like you've done a good job of managing that. If you haven't, then I always tend to say, you know, I've done well, but I think I can do even better. So it's rare for me to give myself a big A, but you know, we've given ourselves a pretty solid grade. I'd say A minus. I feel pretty good that we've caught a lot of these moves because the system is doing the lifting. I don't have to worry about that. I think maybe too many people are worried that everybody's going to see what their grade would be. So I won't put you on the spot. Usually for us, we keep it kind of private so I can just kind of call out the grades. But most people, when I do that, will actually tell me, you know what? They say, haven't done very well. I'm a C. I'm a B minus, a C plus, or the occasional F. The occasional A will pop out, but most of the time people are saying there's a lot of room for improvement. But here's one thing I want to point out to you on this is that when you see this first burst, you know, we actually managed to get our 100% profit target in about 2 hours. We are not day traders by nature, but we basically say, you know what, if we get our target profit, we've learned, we take the money, we run to the next opportunity. But one of the great things about ADX is you notice that even though we got out and then the stock just flatlined and made kind of a flag pattern the rest of the session there, ADX actually kept rising. So if you were just a pure ADX follower, you're saying the ADX trend is still up, and it did pop the next morning. So the good thing about ADX is it's not as reactive as price action. That little bit of lag actually is a good thing to stabilize you needing a whiplash neck brace if you're just trading price action alone. You know, I know some traders that really claim that price action alone is the way they like to trade. I find it's way too noisy, even on a fairly stable 30 or 60-minute chart. We're using 30 minutes here to be fairly quick in getting these entries and, more importantly, these exits. So you see those trades hitting their 100% or on the downside more targets very quickly. But let's look at other things that can happen if you don't get there. So, you know, sometimes it can go up to a smaller gain, sometimes to a flat line, sometimes to a loss. It can pop against. So we want to manage all of that. So here's one with Apple. Now, Apple is one of the most stable names. If it is the most stable name we trade of the big 5 FANG names. Why? Because, you know, it had a nice day today. Bottom line is that, you know, we're buying an in the money option. When we're paying up to $1,000, even to just get one contract, you see we paid an average of $918 to control 100 Apple shares. Look where Apple was trading when we got, now our ADX is in yellow here. Second 30-minute close at 10:30's close, it barely crossed our moving average filter to give us that entry when the stock was trading in the neighborhood of about, you can see, 131. So if Apple's at 131 and we buy a 123 strike call that's going to expire the following Friday. So this is on a Wednesday morning, the 20th, expiring the following Friday, the 29th. You've got plenty of time in this trade. More importantly, you've bought 8 points in the money. You've bought a right to buy Apple at 123 and it's already up at 131, 8 points higher. So you say, well, why do I have to pay $9.18? Why do I not just pay $8? Because that extra portion is called the time portion of the trade. So you're only paying $118 out of your 918 in time risk. There's always price risk, so we've got to manage that. But the idea is that, you know what, if you pay 118 out of your 918 in percentage terms, you're in the neighborhood here of about maybe what, 13% of your total option is time risk, and more than 85% is intrinsic value. So you put yourself right away in a really nice spot to say, I can basically create what I call a stock substitute. So as the stock does start to rally here, and you see it didn't get to our target, and then the ADX is rolling over. When the ADX rolls over, we haven't gotten a target or a stop, we're out on that bar's close here, just under 138. Now, 138, you can see what's the option have to be worth. We'll call it 137.50. At 137.50, it's got to be worth 14.5 bucks. So this is more than a 50% gain, right? Because another 4.5 bucks would take us to like 13.5. We're a little bit above that. We're making 60.78% total profit, again, before commissions, which are minimal. You should be paying less than a buck or less per contract with no ticket charge. So if you buy one lot, one contract, you're paying less than $2 in total commissions. Obviously, buying one of these, you see you make in this neighborhood of more than 500, almost 600 bucks. So you make $500+ off of one trade. So a couple bucks of commission is you keep the vast majority of what you make in this trading approach. It's really simple and effective. Now, we also call this a profit protection stop, because once we start making money and we start getting up into a healthier profit, we will raise our stop from an initial kind of a worst case 50% loss, moving up quickly to like a 30 or 20% loss, then moving up to a break-even stop once we've started to get into a decent profit position. In this case, we had a very healthy profit pushing up towards like 75 to 80%. And when it ticked down here and knocked us out of 60%, we're saying we're done with the trade. As you can see in retrospect, it manages to rally back up after that. That's okay. Would you take 60% for less than 2 days of work? That's what we're after here. Okay. Is that you're basically saying in less than 48 hours, you've got your 60% profit and you're moving to the next opportunity. That's how you have to look at these windows of time where you get these trading opportunities. As I mentioned before, sometimes these ADX crosses, when we get our initial signal here, happen to when it confirms a price breakout. This one here actually is happening ahead of the price breakout. You can see we're actually testing back up near, but not over that last high. So a lot of people would say, well, I'll wait until it more convincingly breaks out that next morning. You can see where we're getting this breakout here. The stock's in the neighborhood of about 116. So what are we buying when the stock's at 116? We're buying a 107 strike call, 9 points in the money. We're paying only $972 to control 100 shares of stock, which, as I said, with Apple, it would cost us $11,600 for 100 shares. So the leverage here is, as you can see, maybe 12 to 1. But the more important concept is that we're able to substitute for the not just the cost, but the risk of all that money we'd have to put in the stock, by putting a lot less dollars at risk with just one options contract. Now, in this case, you see we make 75% the next day as it gaps. This was on the next trading day. It was on a Friday, and we got the signal about 1300 hours, means about 1 p.m. Wall Street time. And you look at this and you say, okay, so we're getting in. We're not making a lot of money into that close. But by the way, notice, look where we got out. We got out about 124, about 8 points higher. If you wait till this thing breaks out on that next Monday morning, you wanted the comfort of being in cash over the weekend or whatever, you've left half your profit on the table. You've missed half of the move from 116 to 120 on the way to 124, right? You only get 4 points of profit instead of the 8 points of profit on the stock that we got, and thus, in this case, turning that $972 investment into the neighborhood of about a $17.5 exit point. So you look at, because you see the stock was 124, it's 17 points in the money from 107 to 124, and there's just a little bit of time premium left at that point. So you look at this and you say, okay, that's actually preceding the breakout. Why would we not make sure it's had a price breakout? Because we're seeing the structure of this has gone from a slow, no clear trend kind of a phase on the left side of the page to now saying that things have changed as we get that signal in here, that the structure is now trending to the upside because the positive is above the negative on the DMI lines, with the ADX having crossed up off of that low 20, just under 20-ish level. So what that all means is that basically you've got a trending structure now developing. So you want to think in terms of what structure you're trading. Are you trading a trend structure, or are you seeing a range structure? We stay away from range structures. We only trade trend structures. The bigger, the better, right? So as we said, Facebook, another one that in this case, it was a little more aggressive option compared to Apple that I just showed you in terms of time premium. That here we're getting our crossover point. It's obviously a bullish cross because the positive in blue is above the negative in red. We're in the neighborhood of about 257.5 or slightly under. But basically, you can see at 257.5, that'd be 5 points in the money. We paid 9.10. So we're about 50-50 on our time and our intrinsic value comparisons. You say, why would you take that much time risk? Because we're going out to the following Friday's expiration. So we know we've got a chance to be in and out of this fairly quickly and not have a whole lot of time decay before that weekend hits, for sure, over the next couple of sessions. You can see from that 11:30 or so entry on that Thursday morning, that next Friday morning at the 10 o'clock close there, we're getting our 100% profit target. Again, if you waited, maybe you could have made a little bit more, maybe not. Maybe it would have been about the same by the time ADX rolls over here. But the idea is that, we want to avoid, that risk of a big reversal. So taking the double as the market makes it available to us has been a nice way to stabilize performance. Sure, we could have had a few bigger winners, but we could also add some bigger give backs too. And by the way, when ADX rolls over, don't bet the other direction. In this case, it does drift off a little bit, but the DMI lines this whole way, even near the end, the positive is still above the negative, right? So from this perspective, blue positive above red negative, this is just a consolidation. But ADX rolling over means you've lost that trend, that strong trend component. So you can see the ADX with the DMI lines overlaid is my secret weapon that basically gives me the clarity to know when we've got a trend structure really starting to develop and something we really want to take advantage of. But what is it all about? Let's actually talk in some, get a couple of descriptions and definitions for you here. DMI and ADX, the Directional Movement Index, was developed by a legend, Wells Wilder, who also invented RSI and a lot of other great technical indicators and approaches. And his contribution here is he said, a lot of people talk about the high-low range for the day. They say, what, the true range should include the amount of any gap, if any. So if you think about like your open, high-low, close chart on one day, and then the next day you say, okay, we'll get another one here. It didn't draw a gap there. So we'll go to the third one in here. We say, okay, and then the next one, we get a big gap up here. A lot of people would say, well, that third day, the range was, we'll call it a little R, was that high-low range. And what Wilder's saying is, whoa, not so fast. Look at the prior day's close here and draw a dotted line on that and consider that that's effectively your low. So prior day's close. And he says the true range, TR, is about double that third day's little high-low range, if not more than double. So the true range is always going to encompass more total movement. And when you divide it out over, if you look back at the last 10, 20, 50 bars of action to get an ATR calculation, that it will show you more total movement. So true range is a real eye-opener for how much that thing can move when you include the gaps. The DMI lines essentially just show you net new highs and net new lows. If you get more new highs and not any new lows, you know what that's called, right? Uptrend. And of course, more new lows, no new highs, downtrend. So what we care about is these trends. The trend phases is all that I want to trade. Don't be tempted to say you want action all the time. Skip the ranges, skip the uncertain periods. Sometimes we just wait and don't have any trades until we get a clear trend developing. That's good trading. Only trade when you have a positive edge. If you don't have an edge, you shouldn't be trading. That's hard for some people that are used to going in and to their day job, for decades and saying, well, I got to trade something to justify my existence doing this. And it's like, no, you don't. You only want to put your capital at risk when you have a positive expectation over a large sample of trades. So if you think about the DMI lines, what is ADX in comparison? I showed you on that other chart that when the DMI plus was rising, the DMI minus was falling. Those create kind of a greater spread between them. ADX will pick up that, hey, that spread is increasing where we're getting more new highs, less new lows. This thing is trending. And so ADX is picking up on a trending phase. Water divided the points of movement over the true range to get a percentage comparison. So ADX can go from 0 to 100. It's rare that it would go that low or that high, but we showed you plenty of times where it's going from the 20s up into the 40s. Let's look at another example. In this case, another bearish example. This is Amazon, and another atypical one because this thing moved so much as it gapped down that next trading day that ended up being an outsized outlier, 243% profit. So again, I just say, even with doubles, we've got a lot of happy subscribers when we're doubling these, but sometimes you get lucky and they go even more. But this is a great example where we got the signal first half hour close into the trade. So we will never do a trade right at the open. Our first trading opportunity with this system on a 30-minute chart is 10 a.m. Wall Street time, 10 a.m. Eastern. Wait for the close of that first bar. At that point, the ADX is starting to turn. As you can see, the negative directional movements above the positive. So what direction is that expecting? Down. And saying, okay, so we're at that close. Amazon's trading in here about 1780. What option are we buying? We were buying, this is back when we used to buy them up to $15. We now buy them only up to $10. So this is a prior period. But you see 1745 and the stock 1780. So essentially we were like 2% out of the money. And you can see even with that higher premium, we still got the 243%. But the key here is, look at this. The first day we're in the trade, it's a Friday, by the way, only slightly right on the price action after that first gap down. That can happen on a gap. You can see an initial pause. Did ADX say you should be worried about this? No. ADX said this thing is still a trend in motion, in this case to the downside. And so when Monday morning hit and the stock gapped down and it moved so fast, and that those minutes after the open, as we got our double order out, it actually was saying, no, you're going to get filled a lot better than that. We got a 243% gain. Again, atypical. We'll take the double anytime we can get it. And if it happens to be better than that on the gap, we'll say that was fortunate. You can see, of course, when ADX rolls over here, starts to flip the other way, we're coming back the other direction. But we're happy to book that profit, take the money and run. How about another bullish example with Netflix? A lot of times you'll see these signals kick off that first half hour of the trading session. Why? Because you're getting news, you're getting other things that are changing, and people are reacting to it. Primarily institutions are the ones driving this. Now notice, how many times do you see this, as I alluded to before, where it opens up a little bit, but then it has a huge first half hour candle there, and you're seeing that it's finishing in here at around 357. We're buying a 355 call, only a couple points in the money, and paying $905 for it, going out to the following Friday's expiration, February the 11th, I think it was. So you look at this and you say, okay, actually February the 8th, as that was February the 1st. So we're on a Friday morning and buying the next Friday's options. We will never buy a one-day option here. We will not play it that close. We'll always go out about a week or sometimes a week and a half. So that's important. Now, when you look at this, you say, okay, we're paying $905. We almost got our double, but then it came back down. We got 85.5% the next trading day. ADX had the slightest little bend there and said, okay, if you are still in and it hasn't gotten your target or your stop, and ADX does bend on us, even for one 30-minute bar, that's enough to say, get out. But if we haven't gotten the target, we already took the money before ADX bent. But if we haven't, that ADX bend says time to go. And you see, it's just steady as she goes. But notice that first day we're in the trade, not much is happening. We're up a little bit by the first day's close there at 4 p.m. on day one, not up a lot, just a little. The second day is where we made most of our hay. So you look at this and you say, well, weekly options mean that now every Friday is a weekly expiration here. On this chart, there's 5 of those weeks on a Friday. It used to be that I would only do this on the monthly options with about a week to go, in the last in that third week of the month. Third Friday of the month is where the monthlies expire, and this chart would be the 16th. But basically now, instead of having one opportunity per month, you can do this 4 or 5 weeks and have a lot more opportunities to do this. This also allows us to adjust around things like earnings. We don't trade these options right in front of earnings. We don't want to pay up for time premium. We want to focus ourselves on, hopefully lower time premium, or if we've got to buy those out of the monies, not holding the trade very long. So while a lot of people traded around earnings releases, I'm telling you with this strategy, don't do it. Focus on the technical momentum that's maybe happening in front of the earnings, or then once the earnings are reported, and take that big gap risk of earnings off the table, because it's wonderful to get positive gaps for you, but you don't want the negative gaps. Now, the weekly options, of course, mean you've got to pay a lot less time premium than buying more time with a monthly or further out option. So you're getting more leverage. But then you combine this higher leverage approach with the high ATR, high average true range stocks, you can dramatically increase your profit potential here. So let me look at an example of kind of how I used to trade versus how I now prefer to trade. When I was launching big trends 22 years ago, and I was saying, I got to make sure that I'm not going to take a big drawdown here as I'm building up this war chest to start bigtrends.com. So, okay, I'll trade something in the old days like Humana. The stock's at 300. What option will I buy more safely? I'll buy a 292.5 call, 7.5 points in the money, and only pay about 20% of that total. About 2 points out of that 940, just over 20% of that option is time, and about 80% of that option is intrinsic value. The delta, if you haven't learned the Greeks yet, the delta means how much should that option move for a 1-point move in Humana. If it goes from 300 to 301, your 940 option should go up 80 cents on that 1 point on the stock. So therefore your 940 goes to 1020, 80% of that 1 point stock move in the option. And as you can see, that daily ATR here was just about 2.25%. And in a points on the stock, that means about $6.80 is a 1 ATR move, one average true range. That what I showed you before, kind of that true range to spread out over whatever it is, a 20 or 50 bar look back period. But now you look at it and you say, that's a nice gain, 57.87% if you get a 1 ATR move. But now look at Netflix. So Netflix, we were looking at some actual option prices when the stock was like 332.5. We're saying, well, to get an option again that's just under $10, you have to buy like a 5 point in the money, and you pay 9.5. So obviously, if 5 of those points are intrinsic, then 4.5 of those points are time value. That's almost 50-50 risk reward, right? In terms of how much intrinsic value, how much time value you have in that trade. But you see the delta is about 60%. So we've got a lower delta option. In the old days, I would think, well, clearly Humana is the more solid play. But what I look at now is, but look, what are we paying for? We're paying for something that's got a lot more daily ATR percentage, almost double, 4.25% versus 2.25%. On Netflix stock, you can see that's like 14.2 points on the stock if you get a 1 ATR move. So what we're saying here is that if you get a 1 ATR move in both of these examples here, with Netflix, you're making 89.2%. With Humana, you're making 57.87%. So 89 and change over 57 and change is 1.55 times, or 55% more profit per ATR with a Netflix type of trade than with the Humana trade. The one caveat to this is if you're on the wrong side and it makes a 1 ATR move against you, you get more of a loss with Netflix than you would with Humana too, right? So this is why direction matters. Getting your direction right is important. I know a lot of people that say, I'm terrible direction, I prefer non-directional strategies. Well, I can show you how to take non-directional strategies and make even more when you get a directional advantage, right? If you do credit spreads or whatever spread strategy to help offset some of your risk, you can still improve that with a directional system like ADX, the big trends way. So now how about another chart here with Netflix to show you how quickly you can get these trades firing off to your targets here. So like I said before, one of the things that you have to change in your behavior, the typical subscriber coming in that sees This thing blasting off the first half hour of the trading day. It started at 495. By the end of that first half hour, it had risen 15 points to 510, up about 3% off of the open. So you go, hold on, I've missed out because it's moved from 495 to 510. Think of these candles and charts here as essentially showing you how much energy you have for this thing to keep moving, especially when you're coming off of that low ADX just starting to launch. It's like a rocket ship launching into space. You get enough power on that, it's going to then be able to coast on its own momentum a lot easier going forward into future time periods here. So you can see in this case, it just essentially never looks back. Every one of those candles here on a 30-minute candle is higher than the last on a close-to-close basis, right? We're having just incredibly persistent uptrend. Of course, the DMI positive is just off the charts. The negative DMI just keeps on dropping because you're getting higher highs, higher lows every single bar or candle in this case. So you see that ends up getting us a double here about 3 hours later, or just under 3 hours later. So again, we're not trying to be day traders, but if we get the double at that point, we'll take it. If we do also hit either our worst case 50% stop, which we put out as kind of a disaster stop to get when we get the position working, we'll say, okay, if we're in at 846, we know we're going to target a double. You can see we took it out at twice of 8.5, just over 100% gain on that in that same day. So the 8.5, of course, meant that we were targeting 17. And you see what the stock did. It went from 510 around the time we got in up to about 535, up about 25 points. And we only took out like 8.5 of those. That's because it was, you can see a 525 call. It was out of the money. It went from out of the money to in the money very quickly. So you can see here that in this case, by the time if you wait for ADX to roll over again, you've now left some money on the table here and you've had more time risk and gap risk the next morning. So we want to take that money and run when we get that double target. If we hit that 50% loss or that trailing stop loss, then indeed we will go ahead and say time to go. So like that Netflix call option, what would that have put? It would put about $848, more than $840 even after commissions in your pocket. And it can happen in a matter of hours. For us, like I said, no more than 3 trading days. So for a lot of traders, it's been a revolutionary way to say, hey, I've been missing out on these big Fang moves because I've been afraid of them. And then basically you say, okay, when you start trading this way, you see what you've been missing. I'm curious if any of you have already been trading the Fang options and how you've been liking them. If you have, anybody traded them, just pop in a Y for yes if you have. The idea is that we don't have to look at a lot. We don't have I've got other methods where I have to scan through hundreds of different stock options to find other opportunities. In this case, I'm just looking at 5 charts with me and my research team all day, every day. And then when we get opportunities, it's like, okay, there's the signal on Apple, take it. There's the signal on Facebook, time to get in. More importantly, there's the exit signal, we need to get out. So we'll constantly alert you as a subscriber to say, you know what, this is what our research shows. We should be in this, or more importantly, we should be out. We never leave subscribers hanging. When I launched Big Trends 22 years ago, that was one of the keys that I said, you know what, I'm not just going to throw a bunch of stuff at the wall and then just talk about the ones that worked. I'm going to say, we'll talk about every trade for subscribers, win, lose, or draw. So you never have to worry about being left hanging. Now, we get some questions about when people are looking at how they can get set up here. And as you see, the stocks we trade, it's really simple. There's just 5: Facebook, Apple, Amazon, Netflix, and Google. What type of option strategy? One of the simplest ones out there, buying a call or buying a put using weekly options. What's the recommended account size? You could start this with as little as $5,000. What we would say is that, just don't want you to overcommit your capital on any one trade. So just know that, if you're putting in, say, getting started with $1,000 a trade at maximum, because we won't ever recommend anything more than a $10 premium or $1,000 at the cap. It's like, okay, well, that would be like 20% of that trading account if it was a $5,000 account. So you just need to make sure that it fits your own risk tolerance. For some other people, they might say, well, I'd really prefer it to be more like 10% of my account. So then they'd start with 10,000, still putting that same 1,000 in. It's just about keeping you in the game, not just financially, but also psychologically. so that if you take a couple of stop outs, you're not panicking. You're not in a spot where you can't let the system go through the ebbs and flows of the market and be around to find that next 100% or better. Now, what's the average contract price? As I said, less than $10 a contract. It's usually going to be over $5 a contract. So basically, you know that you're in a situation where, if you're putting $1,000 in, it's typically going to be one contract per trade at a time. Now that ticket charges are gone on option trades and you're paying $1 or less per contract typically, then you don't have to worry about commissions eating you up like I worried about when I got started in trading back in 1990, where even a one lot might cost me $30 or $40. Now it's less than $1. So you can see how great it is of a time to trade. But never better in my 30 plus years in the options trading world. So you say, okay, how long does a trade last? Anywhere from that same day, anywhere from hours up to 3 trading days at maximum. So it's like a faster swing trading type of an approach. You say, when are the trading notifications sent? Anytime during a trading day, but typically on the half hours for those entries. So if we get a signal at 10 a.m., you can bet that in a matter of a couple of minutes, it's getting fired out to our whole Fang options trader database. So it's really, really clean and simple, and you know exactly what you need to do getting in and getting out. Can I receive the trade alerts via text? Yes. Text is very popular. Right to your smartphone makes it really pop up, so you know exactly what you need to do getting in or getting out. How many new trades? We target about 8 new trades every month, so about 2 trades a week on average, knowing that some weeks we might have none, and other weeks we might have 3. It's just about finding when the sweet spot is. But like we said, if we have 3, we're not going to have more than 2 open trades at any point. So it might be in a couple, then one gets exited, then we've got room for another one. Are we giving you stop loss and profit targets? Yes, we tell you when to get in and when to get out per the system. And what about educational resources? Yes, we've got lots of those on our member site, so you can take advantage of that and really know what you're looking at. Now, I mentioned to you, that past examples on trades, and you wonder, well, what does this really look like? So the big thing is, like, if you're looking at, us calling out a trade, just kind of, let me pull up a past one here real quick, just to get some flavor of like what it would look like as you're getting a trade called out. It's just saying, like, okay, this is one where we had gotten into the Google trade I just showed you earlier, and we were already into it. And then we'll say, okay, let's apply a stop of 1060 to that Google 2740 put. And then we said, okay, target 19. So that was sent out right before the open, 9:24 a.m. back on that Monday, September 20th. Now, if you look at that and you say, okay, so then what do we do after that? When the stock actually gapped past our target, we actually saw the 942. We're saying, hey, right off of the open, we were targeting 19. It actually opened up 2580. So we say, okay, that's the exit price. And we're saying, thanks very much. So you're never left hanging. You get those kind of clear-cut signals where you know when to get in, when to get out. That's really important from my perspective, to make sure that our subscribers never have to worry about when there's an opportunity or when they should no longer be holding a trade. Of course, I've got my 800 Big Trends toll-free number. People constantly calling us. If you have a question, we're here for you. Real bodies, not a voicemail, not a machine, but real people helping traders all around the world here. So what I've done is I've set up actually a really cool package for you. So it's not just going to be trade alerts. It's going to also be a lot of education. I'm going to give you the settings and rules sheet. It tells you all the key filters that you need that I was alluding to, not just with the ADX and the DMI lines, but also the moving average filter and kind of how we do things there. And then you also get access to my weekly video update, where I go through my Fang options trades from the past week and what I'm expecting for the week ahead, kind of overviewing that as part of our options alert strategies every week on Mondays at 6 p.m. And then what I'm going to give you is usually a 1-year subscription would cost you a couple $1,000 buying a year at BigTrends.com. And actually, what I'm going to give you today is not just buying a year. I'm going to give you an extra year on me, what I call a BOGO offer, which would be like almost $4,000 of value on our website, plus the other values there would cost you over $4,500. But I'm saying, you know what? It's my 22nd anniversary. I'm taking it all the way down to $422 for 2 years of access with 2 years worth of video updates, all the settings and rule sheets, and the support team behind you here. Say the 22 for 22 years, $422 is as low as I can go for 2 years. As you do the math on that, that's like less than $20 a month, which on 8 trades a month is getting you in at like under $3 a trade, not even counting all the other educational bonuses. So it's going to give you an insane value offer here. What I'm going to do is I'm going to just post it in here of what we're what the website is, and I'll show you the website here in a second. It's members. I think I've got it on the next page. Let me show you that while I type it in. Members, not www, but members.bigtrends.com /FOT24. Now, FOT for Fang options traders, that's an O, not a 0. And then 24. So when you look at this, you say, okay, that's the best value there, the FOT 24 months for just $422. We will still let you try out 3 months, but the lowest we take that, usually it's the lowest we take it on a monthly would be $97. So for 3 months, that would be like $297, but we're taking it down to $197 for 3 months. Now, obviously, the value is extremely better when you can buy 8 times as much time at the 24-month price. And you know, obviously multiply 8 times just under $200, you'd be at over $1,500 and change for doing this 3 months at a time for the next 2 years. You're not paying $1,500, you're just paying $422 one-time investment. So it's really a fantastic way to go here with that FOT 24 special link. And you can see here, like, you know, what we would call out. Like I said, I did have a couple of these charts here just to show you an example of what that looked like. Like what we said on Netflix, we're buying to open a Netflix week 4, October 22nd expiration. So these will always be on Fridays. And then we even give you the symbol. We tell you what to pay up to 920 or less. We got filled better than that. We got filled at 880 on that one. So we said, put your first stop in there at minus 50%, 440, but we don't expect it to get that low. We expect our trailing stocks to kick in, and then we'll start tightening the stops with follow-up email and text alerts. So we just say, look, make sure you've got unlimited texting, because we will send you regular follow-ups when we think it's time to tighten your stop, or if we've gotten our target, or it's just time to get out if we don't get the target achieved. So that's really important. Now, when you go to that page, let me just look at that, and then I'll answer a few questions here before we wrap it up here. So when you go to members.bigtrends.com /FOT24, this is what you should be seeing. You should see something really simple. I'm a big believer in the KISS principle, keep it simple. Silly, but basically the idea is, that keep it simple, and that'll keep it successful. The idea is that, it's really about just, you've seen how much you can make on one trade. I mean, obviously one trade can pay for more than 2 years of access. I've even had some people from my longtime big trenders who are like, can I buy more than this? Can I buy 2 BOGOs and get 4 years for $844? I'll honor that, but only for this limited short window here, as we just had our 22nd anniversary as of a couple of days ago. So I'll honor it for a couple more days. But bottom line is that for you, if you're new to big trends, just trying it out for that, that low one-time investment of $422, giving you 2 years of access, 24 months of Fang options trades, plus the educational bonuses, plus the support team. You also get a dedicated email to me and my analyst team. So if you've got a question on a Fang trade that didn't make sense to you, or you're trying to kind of get caught up, we can walk you through that too. So it's really a great learn while you earn type of a program to make sure that you're growing. And Jurgen loves the KISS principle too. Yeah, I mean, it's amazing, even in trading systems, how many ways you can mess something up by trying to put too many different indicators. I was talking to one of my coaching students who said, I'm trying to integrate your stuff with what made sense to me from somebody else's stuff. And I said, that's like taking 2 things that are good and then turning it into one really bad recipe, right? It's like, if you like chocolate and you like whatever else. I don't know, pick your, you like potato chips, put them together and they don't taste so good, right? Maybe some people like it, I don't know. But bottom line is that the odds are that you're going to complicate things and make it worse. Keep it simple. So anyway, the idea is that you see that we've got our terms and conditions linked here. Review that. It's clear cut. Like I said, in business 22 years, we're here to make sure that you have not just a satisfactory experience. We want you to be thrilled with the value that you're getting. I mean, I see a lot of people are selling a year of alert services for thousands of dollars. Why am I able to offer it so reasonably at such a great value? Because we've been around a long time. We've been blessed to help so many people. And my experience is, if you get great value, you're going to tell other people how happy you were, and that's how we've grown Big Trends. You don't see me on the infomercials on the financial news networks or anywhere else. I'm saying, you know what, word of mouth is how we've grown the company, with quality being our focus, and not trying to jam trades out, but rather saying only trade when you should be trading. How many recommendations, William says, per week or month? Our target is 8 trades a month. And as I said, sometimes that means we might have more than 2 in a week, and other times we might have less than 2 in a week, but it should average out to about 8 trades a month, or almost 100 trades a year is our goal. And we're usually right in that neighborhood. So, but again, goal being, let's make sure we get you quality first. And if it's not the right sweet spot, then we'll say, let's wait. Earl says, when will this offer expire? We're going to give it the next couple of days, Earl. So it'll be good here through Friday night at midnight. So basically, you can take advantage of that. Give us a call if you've got questions. You can call us. You can review our multiple year track record. I didn't even show that, but it's very good. But we're happy to have you go study it to your heart's content and ask questions about anything that you're not clear on it before you get started. But at this value, we do encourage you to make sure you don't wait around. So basically, we're all about making sure that subscribers all get the trades at the same time and can execute it, whether you're trading one lot or multiple lots. You should be able to get these executed very quickly and easily. We give you room to get in, room to get out. We're not like that. Like someone was telling me some other place that by the time they got the trade, the thing had already moved. We're big on making sure that you can really, truly participate along with the rest of the Big Trends community. So it's that's subscribe to this. Obviously, you've got to become a subscriber to take advantage of it. We don't put any of them out for free on Twitter or whatever. It's like, no, we value the hard work that we do. I've got multiple sets of eyes on this stuff to make sure we don't miss anything, and that we're getting you entries and, more importantly, exits on every trade that we call out for Fang options traders. So let me see if there's any other questions. I know that I don't want to take up too much of David's time. We're right about at that end point here, but I thank David and for having me. It's always a pleasure. David and I worked together many years ago for several years, and so he also brought that systematic focus on how to find an edge quantitatively. And to me, that's the right way to trade, is to have that quantitative edge. If you're just going off of feel, off of your subjective, how'd you feel when you rolled out of bed this morning, I think you're going to find it hard to be consistent in your trading, because you'll have highs and lows that frankly then really test if you're really going to be that committed to trading over the long haul. Sometimes good trading can seem almost boring. It can seem like, hey, this is just following this one indicator with this one couple of setups here in this pattern. I'm saying, yeah, that's what we're after. It's just this very clean, simple pattern that has a better than average chance of repeating and giving us more good ones and manageable bad ones, knowing there's not going to be all winning trades. We're going to have losing trades, but the goal is control your risk on the downside and then let your profits run to a much bigger profit target compared to what your risk is. That's what it's all about. So you can really manage that and take full effect of it. So I want to thank you all for being with us. And I know this Friendsgiving offer, it's and with our 22nd anniversary celebration, it's frankly too low to hang around for too long. I've had lots of subscribers who have paid a lot more than that for even a year of access. So make sure that you do indeed lock it in with that great value. In my feeling very blessed 22nd anniversary celebration here. I'll hand it back over to David, and I want to say thanks, David, for having me. It's always a pleasure.